Hey everybody, today is Saturday, November 10th, 2018. Taking a look at the S&P 500 as we start into November week 3, monthly OPEX week, next week for the S&P 500. Okay, so here we are as we are post-election. We can see, we had our all-time high back here in September. We sold off down to this low. We've come to a fork in the road at this point. Facing the same point that we bounced to the first time we came down here. We have a nice little V formation in here, and we're looking right now to see whether we're going to continue up, or are we going to fill in sideways a little bit before going up, or are we done and we're going to go back down now as we head into what is usually performance chasing time of the year, with Thanksgiving break only another week and a half away. And is this going to be the time that we're going to get that one last big push down that's going to take us and break us down below this low and take us to our targets that we have talked about in that two-part video that I posted for October 26th, and then I posted a review of it, a follow-up of it last weekend, and then I retweeted those links today in the private account so you guys could watch that again, or watch it if you haven't had a chance to yet. So anyway, looking at this little V formation, it reminds me a lot of this little V formation here that happened around the all-time high, and kind of going over where we got to and how we got to where we are now and where we came from, I should say. All summer long, we started with a move here back at when we came off of July 4th holiday, with a nice move up and over through the 50-day, the 10-day, and the 20-day simple moving average, and we had a nice bullish cross that started us off on this summer-long rally. And throughout the summer, all we ever did was, at most, dance a little bit with the 10-day and sometimes poke our head down through the 20-day simple moving average, but always managed to bounce up off of that and find a new high. And over the course of the summer, we made one new all-time high after another. Here was one that we made here was one of the ones we made in July, and another one at the beginning of August, and then another one at the very beginning of September, and then finally our last one to this point now was made on September 21st. And all of these were bounces off the 20-day and so forth. And then even after this one, we rolled over and we came down, broke our 10-day and bounced off the 20-day. And this little arrow right here points to this candle because this was the Fed. This was the FOMC statement day. This was our last Fed meeting before the one that we just had under this arrow, which was on Thursday of this week. So this is what, the market made an all-time high. It knew the Fed was coming, so on the next session we gapped down lower, kind of moved sideways, and then opened in sort of like the middle of the range that we had been trading for those 2 days and flushed down. Saw our low of day and closed just off of our low, but still above the 20-day. And then we recovered for a few days after that, but it wasn't enough to make a new all-time high. We couldn't make a close over the all-time closing high, which was here on the 20th. So we had our all-time closing high the day before, and then we had our all-time high, but then a lower close the next day, and that sort of was the recipe for us to head lower. And when we came back up and couldn't take out that high, couldn't take out that closing high, we rolled over from there. Okay, now I'm going into this detail because there's stuff that's going on here and stuff that went on here at this attempt to bounce that is very similar in style to that. And they are characteristics of the way something is trading that you can take over to any of the other stocks that you like to trade, such as, Tesla, Amazon, Apple, so on and so forth. But in any case, we wound up gapping. When we couldn't make that new all-time high or that new all-time closing high, we gapped down. We traded right down through the 10-day and the 20-day, closing down below it. Then we put a follow-through close in below the 20-day. And we hadn't done this all summer. We hadn't done this since weakness back in May or June. And then we also allowed a bear cross to go through with the 10-day crossing down through the 20-day. And the 20-day was rising at the time, but by a day or two after this cross happened, it was falling too. And that is what sort of instigated this gap down open below the 50-day simple moving average and this horrendous sort of liquidation event that went on for 2 days, bringing us down to 27.10. We were up at 28.80 and we fell all the way to 27.10. This 28.80 is the point where I think that we will probably gravitate back to, and that's where the real decision will need to be made. Because once we get above this 28.80, I think that there's probably a pretty good chance that they meaning, the greater forces in charge of where things land and take off from, being, the market in the makeup of all its parts, be it funds and retail and news cycle and everything. I think that if we get above this point, this is sort of like the scene of the crime where everything just sort of like fell out. If we can get above here, I think then we do have a chance at going after the all-time high and maybe making a new one. But I really feel that this is where things are going to fail. And as those two videos that I reposted today talked about, we know what our target is when things do roll over and we break this low, where we're going to next. Okay, but in any case, when we came down here to 27.10, we bounced up going into the Fed minutes. The minutes for this meeting back here that sort of, established our fate to begin with. And we had made it down through the 200-day. We had a single close down below it, a close above it, and then a close down below it. And then as we were going towards the Fed minutes in a couple of days, we gapped up open and we rallied on up to close back above the 200-day, and awaiting the Fed minutes, hoping that there's something in there that shows us that that Powell's press conference and that his stance and everything maybe isn't as hawkish as we think. But unfortunately, those Fed minutes did nothing to build confidence in the market about an end game as to when rate hikes would maybe take a pause. And then after the market closed that night, Powell was out at an event and made some comments. He and actually a whole parade of Fed speakers were out and about, and he made the comment that if the Fed needs to overshoot neutral in order to keep inflation from getting out of hand, that it will. And the market just took that as the death knell, and that was it. We gapped down open the next day, fell down through the 200-day, managed to close back above it, but then the next day we closed below it, and then finally the next day again we closed below it. This was the first time since 2016 that we had put two closes in a row below it, the 200-day simple moving average. And it's not that people are waiting to sell at the 200-day simple moving average, it's that funds are waiting to buy at the 200-day simple moving average. And they might have started to buy here, but when they didn't get the reassurance about the future that they wanted from the Fed, they were not there to save the market, and the market just liquidated on down all the way to 26.03. And now here we are again. We've bounced. We've taken back the 10-day. We've put in several closes back above it. We've taken back the 20-day, and we've put in 4 closes above that so far. And then we had our pre-election little rally that sort of left us parked right underneath the 200-day, and then we gapped up open back above this 200-day. After spending 13 sessions in a row closing below it, we finally gapped up open over that on Wednesday this week after the election and had this great rally. The middle point of this rally, the halfway back in the day, is this 27.94 level. And then on Thursday, we had the Fed again. So here we are back to the scene, the same scene we were in here and the same scene we were in here. And there was no change to the statement from the one that was given back here in September. So nothing new negative, but nothing new positive either. Then on Friday morning before the bell, we had the PPI report come in, and apparently that came in much hotter than expected. So we went and we gapped down open right on that halfway back point and worked our way on down over the course of the day. And our low of the day held just a couple points above where the 200-day simple moving average is, but it did sink its teeth into this gap. We had a gap that was about twice as wide. And then with this low on Friday, we shrunk that gap down considerably. And that is healthy. But that is healthy when you go into a gap, but you don't quite fill it, and you reverse and you rally back up off of it. Now, we left the candle very red for the day, but we left a long buying tail on it. We took back more than half the day's range. The halfway back on the day Friday was 27.79, and we traded all the way back to 28.81, 27.81 to close. And so that's positive. That's regaining more than half the day's range. We also gained well into the range of this day that we traded the day after the election, the big rally day. So as long as our closes remain within this range, it seems like that's a pretty good safe spot to be. You can see the close on Thursday was in here. The close on Friday was in here. We can have intraday highs and intraday lows below here, but the closes need to be at least at minimum within the range of this candle. Okay, so if you're wondering about whether you should be in puts or in calls, that can definitely make you feel a lot more safe to be in calls as long as we're closing within the range of this candle. And if we're closing above the midpoint of this candle, above 27.94, that's definitely more bullish than it is bearish. And when we're closing below it, that's a little bit more bearish than it is bullish, but it is still bullish as long as we close above the low of this candle at 27.74. I hope that makes sense. If it doesn't, shoot me a direct message and I will explain it a little further. In case I didn't mention this already, I just wanted to say this too. I've shot this video about 5 or 6 times today, and I don't remember what I've said so far on this version of it. But something very important, this rally compared to this one. Yes, this still remains our bounce high, 28.17. It's like 28.16.94. So I'll just call it 28.17. And we only bounced to 28.15 here on this high, but we put in a higher close. We put in a close at 28.13 versus 28.09. And then when we traded the day of the Fed, we had this battle going on all day at 28.09 to 28.10. And that's the reason why, because we were battling this closing high from back here. So I think that is an interesting point that the market made on Wednesday, was that we made that higher closing high, even though we didn't get that higher intraday high. I thought that was very interesting. I also thought it was interesting that we have followed through with 3 days of closing above the 200-day. And then, of course, my big sales point for why I thought we were going to rally on Friday was this bullish cross of the 10 and the 20-day. Remember back here, this jaw-dropping event here where we finally saw the 10-day cross down through the 20-day? Well, this is the antithesis of that. So when we opened down on Friday and we sold off down through it, it stopped this cross from pulling through. But as long as we are at least flat at the open on Monday, this cross is going to pull through, and it's sort of inevitable that we will rally. So if they don't want this cross to pull through, and they being the greater players of the market, really want things to be under control next week and drive prices a little lower so that they can get roll into calls that expire maybe next week and get out of these monthlies, and they want to facilitate better prices for calls, then they're going to push the market down. If they don't care about that and they want to buy puts instead, then they're going to push the market up to facilitate that, and they will use this bullish cross and let that happen. Okay, I can't remember whether I went over this. I hope I'm not being redundant, but here's our calendar for next week. We had the FOMC statement on Thursday. We had the PPI on Friday. Monday is a bank holiday. There could be thin volume. All the markets are open. Fixed income's closed, and banks are closed. A lot of schools are off for the holiday. There might be a little bit of thin volume from that because people are off on long weekends with their kids being off from school. Tuesday, we have nothing going on of note in the calendar, but towards the end of the day on Tuesday, there will be some angst getting ready for the CPI report, which comes out before the bell on Wednesday. And then guess what we have after the bell on Wednesday? We have another edition of Powell takes the microphone in the after hours. And that's what killed us back here. So if he just simply does not say anything about monetary policy, specifically about, amount of rate hikes or what neutral is or shooting for neutral or anything like that. As long as he stays off the subject of policy, the market will have a reason to wipe the sweat from its brow and move on, move on forward and up when we get into work on Thursday. If he says something about policy, and this guy knows now what the effect of that is going to be. Does this guy want to see the market burn to the ground? No, I'm sure he doesn't. I'm sure he doesn't. I'm sure he's like not happy about what happened here, unless he's the friggin' devil himself. I mean, why would you be happy about this? So I would think that at minimum he'll probably not say anything at all. It'll be a non-event. Everybody will have been, all, riled up about that, and it'll turn out to be a relief rally, much like what we saw here last week on anticipation of the election. Okay, so anyway, I hope this helps you out. I hope this made some sense and gives you a good start on the week. If you don't know what I was talking about when I spoke about that two-part video that talks about where we're going to go when we finally do break 2603, I reposted those links today, and I will post them again if you can't find them. They're in my, my Saturday feed, which I don't tweet a lot on the weekend, so there isn't much to go through. And starting next week, I'm going to try and be a little bit more concise and not tweet so goddamn much that you guys have to fish through dozens and dozens and dozens of tweets to get to the information. I'm going to try and be a little bit more concise, because right now I think it's really important for us all to concentrate and not have to read through a lot of redundancies and so forth, and just get to the information as quickly as possible. And of course, I hope you know that if you're ever in a trade during the day and you just want someone to talk to, you can DM me anytime. I'm always there for you. I appreciate your donations very much. Thank you so much for watching this video. Have a great rest of your weekend.